Alright, so previously we talked about the FTC, the foreign tax credits. You might think, well, that's a good thing, huh? It's the tax credits. So where's the catch? Yeah, you got it correct because, everything got a catch. You know what? There is a big catch here. That means the IRS only gives you a credit up to a certain point. Okay? And that means the credit up to the US tax that would have applied to you to your foreign income. Okay? That may seem a little bit like, what the heck is going on? Okay? Let me use a little healthy amount of mathematics to help you, understand it. Don't get freaky out because you know what? The math is so simple. Okay, I'm going to show you. So basically, the formula is like this, and it's it's kind of like a timeless formula, and it has been changed for decades. Okay, so that means the FTC allowed. That's the up to a certain point. That FTC allowed means the U.S. tax multiply foreign income divided by worldwide income. Okay, let me just help you with the great mathematics. All right, so basically, say you got a worldwide taxable income. Okay, so your worldwide taxable income is, say, you got like multiple sources, and in the year end, we got $100,000. Okay, that's a lot. Come on, that's a lot. That's a really decent amount of income. But you know what? There are some of the foreign taxable income. Okay, so say the foreign taxable income is say $20,000 US, both from China and Japan. All right, so we got like a two item here. Okay, so we are talking about income here. One income from worldwide, the other income is from foreign taxable income. Okay, so when you calculate the whole tax return, say you got the US tax that you're going to pay, so say maybe $22,000 US. Okay, that's your US tax. And say you already paid some tax in some foreign countries. Okay, so for example, there are some of the foreign tax. You can even pay multiple countries' taxes. Okay, so for example, the foreign tax that you paid, you add all this up is say $6,000 US. Okay, that sounds make sense, right? So how to apply the formula? You got the US tax. Okay, so you use the $22,000 US. Okay, and you multiply foreign taxable income, right? You got foreign tax income of 20,000, so $20,000 US. Okay, and you divide it by the worldwide taxable income of 100,000 US. Okay, that will give you 4,400 US. Okay, so basically this year you can claim you can claim 4,400 US. Okay, but here is the catch: you already paid foreign tax of 6,000 US. Okay, so you already paid. That's the money already paid to the foreign government, right? So how does it add up? This 4,400 US is less than the foreign tax that you already paid, which is 6,000 US. So basically, you can only claim that amount of credit. And there is the mismatch, okay? So we're going to subtract the 4,400 from the 6,000 US, and we can subtract the 4,400, and then, and we got the 1,600 US, and this amount is a mismatch. So this year, you can claim 4,400 US, but you got this extra here. You got this extra 1,600 US that you can carry back for 1 year, or if it's not used, you can carry forward, right? Up to 10 years. That's amazing. Come on, up to 10 years. Right, that's the whole process. So basically, without FTC, you will pay the full foreign income tax, and also you plus the US tax. So it's the typical scenario of double taxation. Okay, that's really painful. And with the FTC, you can reduce your US tax liabilities, and you can reduce to that amount by this creditable amount. That's the I already introduced you the formula. You use that formula to calculate that amount. That's the top amount that you can get, and essentially saving you thousands of US dollars.